Hey everybody, Smart Silver Stacker here. Hope you're doing well. Both gold and silver have pulled back from their recent highs, but still, the year-over-year performance for the precious metals remains strong. The gold price is up 36% and the silver price is up 34%. And while I still view both as undervalued, there are metals out there that could leave them in the dust. Today, we're diving into the metals that no one is paying attention to: platinum, palladium, and some even more obscure ones that are setting up for explosive moves. And let's start off today with platinum and palladium, two critical industrial metals that have a very interesting setup right now. President Donald Trump just rolled back EV mandates, so gas-powered cars are going to be sticking around longer than expected. More internal combustion engine cars equals more catalytic converters. And that means more demand for platinum and palladium. But it's not just demand for these metals that is on the rise. We also need to examine the supply side, because for palladium in particular, supplies are critically tight. If we take a look at the most recent data from the COMEX, we can see that they've got a total of 408.6 million troy ounces of silver, 39.2 million troy ounces of gold, 545,000 troy ounces of platinum, but only 76,196 troy ounces of palladium. That is a very small number indeed. So with such a tight supply, any change to the demand of palladium can affect prices significantly. And palladium has experienced some drastic price swings over the past several years. In 2022, the price of palladium spiked up over $3,400 following the Russian invasion of Ukraine. Part of this was due to supply chain worries because Russia is a major producer of palladium. But today, palladium is down about 70% from its 2022 peak. It's trading currently under $1,000 per ounce. And yet production is still concentrated in the BRICS nations, Russia and South Africa. So further geopolitical turmoil still has the potential to cause another spike in the price of palladium. But if you think that palladium's price swings have been wild, we should take a look at the chart of rhodium, another platinum group metal. From 2016 to 2021, the rhodium price spiked from about $600 to over $29,000 per ounce. That is nearly a 50 times move in just a few years. Now, what caused it? Well, rhodium has an ultra low supply. There's about 1 million ounces of the stuff produced every year. And there was an increase in demand for catalytic converters, and that led to industrial panic buying. And the lesson that we can learn here is just how significant the moves in these smaller metals markets can really be. There's also another lesson to be learned, though, because the price of rhodium, while it's still up significantly from 2016, it has corrected down to about $4,700 per ounce. So if you are sitting on profits in one of these smaller, more illiquid metals markets, it is probably a good idea to take at least some of your chips off the table, because the spike can come down just as fast as it goes up. Now, another metal with major geopolitical risk is tungsten. China recently banned exports of tungsten. Why does that matter? Well, tungsten is critical for military supply chains. It's used in everything from armor-piercing rounds to aerospace applications. And if the West loses access to China's tungsten supply, prices could spike just like rare earth metals did back in 2010. Now, I'm not suggesting that you go out and you try to stack up physical tungsten. However, it is a metal which has a tremendous potential for significant price movements due to geopolitical tensions and disrupted supply chains. Now, we've talked about metals with explosive price potential, but there's one that is more than just an investment opportunity. This one is actually putting America's national security at risk. Talking about antimony. Antimony is a metal that China dominates the production of. In 2023, China mined about 40,000 metric tons of antimony. That is almost double the next largest producer. This is a metal whose production is controlled almost entirely by geopolitical rivals to the US. For decades, the US has depended on China for antimony, a critical material for military and industrial supply chains. Without antimony, modern warfare becomes nearly impossible. No antimony means no military electronics, no armor-piercing ammunition, no missile guidance systems, and no nuclear weapons. And recently, China has banned exports of antimony, cutting off the US from its primary source. This supply shock has already sent prices soaring, approaching $50,000 per ton. Now, a major problem is that the US stockpiles just 1,100 tons. That's compared to 23,000 tons that were consumed in 2023. So that means that the US has only 17 days worth of reserves. The Pentagon is scrambling to secure alternative sources of this metal, and that's where today's video sponsor, Military Metals, ticker MILIF, comes in. Military Metals is securing Western-controlled antimony supply, one of the few publicly traded companies working to solve this crisis. Their flagship project, located in Slovakia, holds one of the largest known high-grade antimony deposits outside of Russia and China. This resource is based on a Soviet-era historical resource, which is currently being converted to a modern, compliant resource. They also own 2 past-producing antimony assets located in North America, including the West Gore mine in Canada, which contains surface piles of ore from previous production. The U.S. Department of Defense has already invested millions of dollars in Perpetua Resources for its U.S. antimony project. With the Pentagon and NATO rushing to secure domestic supply, Military Metals is in a prime position to be part of the solution. Currently, Military Metals has a market cap of less than $23 million US. Given the scale of the antimony crisis, the Pentagon's urgency, and China's recent supply restrictions, this is an incredibly small valuation for a company operating in such a critical sector. Now, as always with small cap stocks, these are high risk, high reward plays, but it is one of the few publicly traded companies positioned to benefit from this unfolding supply chain crisis. The urgency is clear. Without antimony, modern warfare is impossible, yet investors are asleep at the wheel. Antimony prices are soaring, the West is scrambling for supply, and Military Metals is one of the few companies positioned to capitalize. Now, don't go out and buy this stock just because you heard about it here. You've got to do your own due diligence. A great place to start is by visiting militarymetalscorp.com. There's a link down in the description. And now would be a great time to begin your due diligence on Military Metals Corp, ticker MILIF. Now, here's another metal that could be the next one with a supply chain risk. And what I'm talking about is nickel. Nickel has already experienced a short squeeze. Back in 2022, prices spiked from $25,000 a ton to over $100,000 a ton in a very short period of time. In fact, that short squeeze threatened market stability so much that the LME had to halt the nickel market. Now, that action did bail out the shorts that time from a major squeeze, but the thing is that every time paper market controllers like the LME pulls a trick like that, they reduce confidence in paper markets. So the next time could play out differently, and we could be shaping up for another squeeze in the nickel market. Indonesia, which is by far the world's #1 nickel producer, just joined the BRICS bloc of nations. So we got to keep an eye on the nickel market here. And as a bonus tip for stackers, if you want to get exposure to some nickel, you can actually just buy US nickel coins from your bank. They are composed of 25% nickel, 75% copper, and currently the melt value is actually higher than 5 cents per coin. Or if you want to find some pure nickel bullion coins, older Canadian nickels are actually composed of 99.9% pure nickel. And speaking of copper, this is one that we need to keep an eye on as well. Now, 10x might be a bit of a stretch for copper, but copper did just break out of a major downtrend just this past February. And currently, AI-driven demand is forecast to nearly double global copper consumption. So the case for copper moving forward, if you ask me, is quite bullish. And you could always stack up some copper bullion like this 2-kilo copper bar. However, as I mentioned earlier, you could just go with US nickels, or if you have the time to sort through some old pennies, pre-1982 pennies are actually 95% copper, and currently they're worth about 3 times their face value. Now, as we talk about metals with significant potential upside, it is almost impossible not to mention silver here. With the current gold to silver ratio around 90, that is at the very high end of the historical ratio. The case for silver has almost never been stronger, and this remains my core position. While I may diversify and dabble in other metals, I am still focused primarily on stacking silver. And honestly, a 10x in silver is not that much of a long shot. The inflation-adjusted all-time high for the silver price is still over $200, and that's just using the official CPI data. If you use some alternative calculations, like the inflation data from John Williams Shadow Stats, then you would need a much higher silver price, and 10x honestly could just be the beginning. And the big takeaway and my conclusion from today's analysis of these metals is that metals with tiny illiquid markets can see price action that gold honestly never will. Not that stackers shouldn't have some gold, but if you do want some exposure to potentially bigger price moves at the expense of some added risk, then some of these more obscure metals should be on your radar. But what do you think? Are any of these metals worth stacking? Have you picked up any palladium, platinum, or something even more obscure? Let me know in the comments. Thanks for watching, everyone. Stay safe and happy stacking. Smart Silver Stacker, out.